Let's quickly start off with the macroeconomic picture, what we're seeing on a global level. And of course, the most recent data that was released, we had PPI numbers out in the US that doubled in February from 0.8% to 1.6%. Does that mean that we're seeing inflation feeding through? And just keeping in mind, consensus was sitting at around 0.7%.
Well, of course, at the PPI level, which is much closer to your commodity prices, you would tend to find that higher commodity prices feed through much more rapidly and much more sharply. But if you look at the consumer price level, I mean, that data will be released tomorrow, and there it's basically expected to still show very tame core inflation. And I think what's important is, it depends on which central bank it is that's reacting to it. Certainly the Fed views these price shocks as transitory and impacting headline inflation, but not core. So the US economy is not quite out of the woods, and the weak housing stats you highlighted certainly makes that point. So the Fed is definitely in no rush yet to hike rates, but in other areas the time is probably ripe for more tightening, and that depends on where you're growing in terms of your own potential growth.
Oh, well, it's quite interesting. I mean, looking at the overall inflation scenario that is playing out, given the fact that it's doubled the PPI number, and I understand that it has to do more with the commodity side of things, does that not signal that we are going to see much stronger inflation than anticipated in the US?
Certainly the risk is biased to the upside, but again, there's probably a delayed pass-through. In terms of the US, it is actually a relatively closed economy, quite a high level of competition, and therefore you tend to see a combination of inflation, but also a lot of margin absorption of higher input costs. And I think what's important, particularly from a developed market perspective, is that wage growth remains very tame. I think the worry will be if you have long-term inflation expectations pick up, and then also your wage growth, nominal wage growth, pick up more strongly. And that's certainly not on the cards yet. Also, if you look at the case in the UK, so the BOE is under pressure from the markets to hike rates, so sort of give it a credibility hike. But if you look at broader price pressures in the economy, still largely absent. I think it's different if you look at emerging markets, a case like South Africa, where probably the pass-through to CPI is much larger and also much quicker.
Let's touch on South African economic data. Retail sales for January hit 6.4% year on year. Consensus was of 7.5%. The December number was unrevised at 8.3% year on year. So clearly quite a disappointing number, would you say?
Yes, I mean, certainly at a headline level it was a disappointment, but if you look at the seasonally adjusted data, it rose 1.5% month on month. That followed a 1.6% gain in December. So still relatively firm. If you look at the quarterly, momentum is actually picking up. So possibly you could have a similar contribution to GDP growth in the first quarter of this year that traded in the fourth quarter of last year. So on the whole, doing okay, even though it was below expectations, and certainly not a consumer that is really in dire need of very low interest rates when it comes to its own expenditure.
Well, again, I allude to the consensus number. It seems that we're not getting these numbers right. What do you think the disconnect is at this point?
Well, I think, the point is, if you look at the December data, that actually positively surprised. So certainly consensus can't have it right every month. I mean, the trend has been, I think, on balance firmer. If you look at sort of the last 4 months, retail sales have actually grown firmer than expected. I think what we need to be worried about in the months to come is whether basically the consumer can stomach high inflation, particularly if you look at oil prices. That's fed through into the petrol price. Petrol price is already 8% higher now than it was in January. Food price inflation is turning more quickly. I think next week's CPI data will be very important in that regard. Also, you're facing another round of 20% plus electricity tariff increases. So I think, while the January data is all well and good and historical, the worry is whether the consumer is strong enough to withstand all these price pressures. And for example, what you've seen in the manufacturing business confidence survey that was released yesterday, you actually did see a better ability of manufacturers to actually pass on higher input costs. And if that becomes a generalized issue, the consumer, I think, is in for a tough time, second half of this year.
I mean, second half of the year, we're talking about a weaker local currency. We're talking about higher inflation as well. And there's a lot of views that we could see an interest rate hike as well. At what level do you think the Reserve Bank will be comfortable to start hiking rates when it comes to the retail sales number? Because we still need to see some stability coming through there. If we see retail sales dropping from the 7.7% that many were hoping to see, now it's at 6.4%, and what if it drops even further than that? Do you think that the Reserve Bank would be making a move on the interest rate front?
Well, I think the point you highlight is key in terms of the balance between inflation risk and growth risk. And certainly our view is that the Reserve Bank will prefer to take a very cautious approach in terms of tightening. Now, it's hard to say what sort of a magic level will be on retail sales. Certainly the consumer is doing much better, and I think what the Reserve Bank has done is to shift some of the growth focus away from the consumer and rather to the corporate sector. So, I think retail sales will hold up okay in terms of sort of 5% real level, which isn't too bad, slightly above trend. I don't think if you have high unemployment that you can really hope for much more. I think the focus of the SARB is going to be what's happening to private sector fixed investment, and I think they'll be a bit more careful to be too preemptive in terms of normalizing monetary policy if private sector fixed investment hasn't really gotten off the ground, and so far we haven't really seen that pick up. So I think they'll stay back for at least the first half, probably well into the second half. Our first hike we've penciled in for November only.